the biggest lesson is don't be fooled and be overconfident, okay? Because you are the first person who is likely to be fooled by your own conviction.
My name is John. I'm a CEO of a Business 101 Publishing and a co-founder of a fintech company, SigmaPlay.ai. I'm here with Mr. Giuseppe Paleologo. He is the head of quantitative investing research from Balyasny Asset Management, the author of Advanced Portfolio Management and Elements of Quantitative Investing. He is one of the leading experts in quantitative investing in the United States, and we are pleased to have a conversation with him today. We will cover many different topics, especially how financial institutions use the quantitative investing framework or incorporate AI technologies into investment decision-making processes, including analyzing financial risk or managing variety of asset classes in a portfolio where different investing strategies can be used. Mr. Paleologo, thank you so much for joining here today. Can you tell us your background, how you started your career, and what inspired you to write the Advanced Portfolio Management and the Elements of Quantitative Investing?
So first of all, thanks for having me. You were a great editor for the Korean edition, by the way. I had a very careful reader, so thank you for that as well. Yeah, so my background by training is not in finance. I studied as a physicist. Then I got my PhD in applied mathematics, and I worked as an applied mathematician at IBM Research for about 9 years. And then I had maybe a midlife crisis, or I just wanted to make more money. I'm not sure, but I decided to switch to finance. I wanted to switch. IBM Research wasn't doing as well as historically had. So, and New York is the place to do finance, the way that the Bay Area is the place to do startups. So there I went. And so I changed field, but I feel that I haven't really changed the job that much, because physics, applied math, and quantitative research have in common that they're all about modeling reality. So I still do the same thing, which is I do mathematical modeling of real world problems. And I have worked always on the buy side. For those who don't know the difference, buy side is the side of the part of the financial industry where companies are taking risk as opposed as facilitating trades. They do take risk as well. Banks do take risks, right? But lately I've been at Balyasny for about a year.
I would like to start with the questions about Balyasny Asset Management. Can you briefly tell us about your company?
Yes. So Balyasny is a hedge fund, first of all, and it is about 25-year-old. It has about 29 billion dollars AUM, and it is a so-called platform. So a platform is something more than a multi-manager hedge fund. Is a firm that is designed for scale, and it has, opposed to a multi-manager firm, which could have more than one PM, but typically less than 10 or 20, we have more than 160 portfolio managers. So that's a large number. So anything bigger than 100 PMs, it's quite large. and it's a quite successful firm at that. So there are a number of platforms, but typically the top 4 platforms are grouped together as being somewhat more scalable and more stable and better maybe than the rest of the pack. They're just considered differently, and those are Citadel, Millennium, Point72, and Balyasny. And so within Balyasny, we pursue a variety of investment strategies. We have historically traded long-short discretionary equities, but then we have expanded into macro, directional macro, relative value fixed income, directional fixed income, various arbitrage strategies, systematic equities, and commodities. So now we have a variety of strategies, and that's why we have 160 portfolio managers.
So from your perspective, what defines quantitative investing, and how does it differ from traditional investing, such as value investing?
Yes, well, quantitative strategy is a little bit of a catch-all term. It's anything that is, programmatic, that follows some predetermined logic, right? That's as opposed to discretionary strategies, right? Within quantitative strategies, you can have many, many different strategies. So very, very generically, there are like 3 ways to make money above your bank account, right? Above the rate of your bank account. The first is well known, is so-called factor premia. Okay, and I think that some of your readers might be exposed to this investment style. You basically want to take exposure in your portfolio, positive exposure in your portfolio to certain investment styles. Like I'm going to buy companies that have high value, like high earnings to price ratio, book to price ratio, or they have high quality, like maybe high free cash flow to enterprise value ratio, or you want to buy momentum stocks that have appreciated over the past 6 months to a year, and so on. You want to buy small caps as opposed to large caps. These are all factor premia, and they are traditional quant strategies. So this is what focused on in the past 40, 50 years. There is a much less known area of quantitative investing that has to do with arbitrage. What is arbitrage? Is essentially when you can almost for sure buy something at a cheaper price and resell it to somebody else for a higher price, right? So in principle, 2 products that are exactly the same should cost the same. But in practice, it's not always the case. So product A and B are identical, but A is cheaper than B. So what you can do is, I am selling A and I'm buying A and selling B, and I'm making a profit. So a lot of these are things like merger arb, ETF arb. There are some exchange for physical, which means that you buy a physical commodity and then you sell the financial product. There are many, many variants of this. The last type of strategy is information-based. And this is what people call sometimes stat arb, but statistical arbitrage, but there are many others. Reasoning about the data and finding that some assets are simply mispriced. And so when they're mispriced, you buy them or you sell them, and then you sell them or buy them at a later date for a fairer price. And this happens typically on shorter time scales, right? On very long time scales, usually you have discretionary people. There is not a lot of systematic. And this is part of our systematic strategy. So that's how we do make money. So there are several things that should cost the same, but they don't. Like if I buy a future on a bond on fixed income, for some reason it's more expensive than buying the bond itself. And the reason is that the bond is less liquid and the future is very liquid, and that the bond has different funding characteristics than the future, so it can be cheaper or more expensive because the collateral structure is different. And so this is different, but the payoff is the same. And so you can take the spread and make some money. It's typically very narrow. There is also a spread between bonds that are on the run, which means that they're being auctioned, they're brand new bonds, and off the run, which are bonds that have been auctioned even 2 weeks prior, a month prior. The off the run bonds are much less liquid, and because of that, they sell at a discount. So in that case, you buy the off the run, and then you sell the on the run.
You spent 8 years at IBM. How did that experience influence your transition into finance career?
I think that my main motivation, honestly, was financial. I think that there was a little bit more money to make in finance than in pure research. And that's not necessarily the reason why I stayed in finance, right? I did stay in finance because I'm enjoying it as a type of job is great. But at the time, I felt that there were more profitable ways to use my skills, okay, for me personally. And so that's number one. Number two, I was interested in finance at IBM, but I was feeling always an outsider. Like I didn't know what was it like, so I was curious. I wanted to find out, and so I decided to go work there for a year or two. Um, my manager at IBM would have hired me back, so it was relatively low risk, and so I gave it a try.
There's a view that quantitative models don't fully capture the qualitative factors such as the company's intrinsic value or management quality. What's your perspective on this?
The data that you mentioned are in a sense very much at this point commoditized, right? They're table stakes. Everybody has those data. The information is completely priced in. So if you want to make money in systematic strategies nowadays, you have to follow, different data sources and different techniques. The good old day of, for example, right, collecting insider trades, executives selling stocks and taking that as a signal that if an insider is selling stock, typically they're bearish because they're selling now. At this point, it's already priced in. So it's so we do use qualitatively a lot of the same reasoning as before, right? But both the data and the techniques have changed over time. They've become much more sophisticated. Even, let's say, the value of a company is a little bit of it's a little bit too much. In some cases, fundamental portfolio managers look at the value of the company a lot. Whereas I think a systematic PM typically looks at differences in value of a company. That's important. So one thing is when you look at an absolute number, and one thing is when you look at the change in a number. So I personally, if I'm a systematic PM, I don't know that IBM is worth $300 billion or $310 billion. But what I do know is that there is a signal that is correlated to the value of the company. And I see that signal to changing from yesterday to today in one direction. So I know that the value has changed more or less in some direction. That is very different than what a fundamental PM does, which is I have the fair value of the company. It's different than the implied value, the current value of the company. And therefore I take a fundamental position and I stay there for a long time.
At a high level, what types of market signals do you typically pay the most attention to when developing the quantitative model?
Well, that is something that I can't tell in public, right? That this is part of the competitive advantage that a firm does have. But I would say this. Way back in the days of, let's say, 20 years ago, right? 20 years ago, you would be pretty much satisfied with market data, right? Of course, you want to have price, return, dividends, and also accounting data that you would get from firms like WorldScope or CompuStat, right? Those would be the data that have been collected from the quarterly or annual reports of the company, right? So cash flow statements, balance sheet, right? All of that goes into CompuStat and WorldScope. Now, we live in a very different world. We have transactional data. We have bespoke data that we collect from web scraping, from vendors that will collect all sorts of unstructured data, like take pictures of the parking lots of big retailers, right? So you can see foot traffic. You can measure activity on cell phones. You can look at social media. You can look around, like you can find a lot of information out there. And all this information is in itself very imperfect. If you're looking for one piece of information that is the most informative, is the current price of a company. But thank you very much. That's not what you want, right? That single number collects together a lot of information. That's great. That's why markets work. But if you want to find the difference between the current price and the future price, you have to basically play a game of it's a mosaic game, right? You put together many pieces of a mosaic, and also it's a little bit like a puzzle. You have a picture in mind, right? So you have to put the pieces together in a certain arrangement in order for the pattern to emerge. So the same thing is with systematic data, with data. You have a large budget. They're very expensive, and then the trick is in paying the bill and putting them together. So it's a little bit like this. You buy a puzzle, it's a very expensive puzzle, but then after you've bought the box with the pieces inside, you have to be smart enough to put them in the right order. I would say this paradoxically, okay, maybe paradoxically, but the world of finance mostly is not a world of big data, okay? By this, I mean that compared to the data that you do get when you work, let's say, on web search, right? Or the amount of data that a firm like OpenAI or Anthropic have to process, our data sets are relatively small, all right? There are not that many data for a medium to long-term investing out there in the world, because there are, let's say, 40,000 companies in the world, maybe way fewer, and they basically produce fundamental data on a quarterly level. They will produce transactional data on a weekly to monthly basis. So the number of data points per company is not huge, and there are not that many companies. 40,000 companies is the number of inhabitants of a small village in Korea or a medium-sized village in Korea. Now, there is one exception to this, which is companies that do high-frequency trading. They need to have access to transaction-level disaggregated data for the markets that they operate in. These are relatively large data sets. Not incredibly big, but they're pretty large data sets. And so they require more computational power. But you can be a reasonably effective systematic PM with cloud computing resources, right? And a lot of the of the tools that are used for processing data are nowadays open source.
A lot of retail investors in South Korea are becoming interested in the quantitative investing. What are some practical ways they can learn and apply basic quantitative investing concepts such as risk management or data-driven decision making? And if you were to design a learning tool, what features would best help users understand investment process and risk?
Well, aside from being passive investors, which is probably the single best piece of advice that I would give to everybody, I'm not a retail financial advisor. So, but in general, there are some lessons from quantitative analysis. So one is to diversify, right? Many investors do not diversify. Okay, there is actually an overarching lesson for investors of every stripe, both professional and retail investors, which the biggest lesson is don't be fooled and be overconfident. Okay, because you are the first person who is likely to be fooled by your own conviction. And intelligent investors incorporate uncertainty and ignorance in all their decisions. In practice, what does it mean? Many people are overconfident and they will hold very concentrated portfolios. Okay, problem number one. It's very difficult to select the right investment. So that's the value of diversification. The second lesson that even very experienced portfolio managers have not learned is do not overtrade. Okay, overtrading is an endemic problem everywhere. Why? Because people again think that they have a ton of skill in timing the market, and they typically do not. A third lesson is responsible risk taking. Okay, so many people are overconfident in their ability to stomach losses, and typically, I have seen very smart people. I know several colleagues from IBM went to cash, which means that they sold all their risky assets in their 401k, in their retirement accounts in October of 2008. So they crystallized their losses. They had lost 40% of their values. They went to cash and they went back into, securities after the securities had regained 20-30% of their value. There is nothing worse than exiting the market at the bottom of a drawdown and re-entering it at the top. So in short, don't be overconfident about your own ideas, selections. Don't be overconfident about your ability to time the market. Don't be overconfident with respect to your ability to take losses. All of these things are cured to some extent by taking a right amount of index risk, right? Investing in some index, diversified index, and a money market account. If you want to deviate from this, do it, but weight your information edge very carefully. Like you need to know the company that you're investing in very, very well in order to think that this is mispriced. So there is a lot, there is a lot to learn, but in a way it's interesting. Is negative knowledge, is the knowledge not to do something as opposed to do, oh, these are the steps that you have to take to pick up the next great stock. Now, in StatArb, people trade a lot. They trade in and out multiple times a day in some cases, right? But they do this rationally because they do have information. Whereas many investors don't have any real information, they don't have any edge. They just do it because they feel like it. They also get a rush from it. They get pleasure. They think that they can read the market, and nobody can read the market. It's very hard to read to so-called read the tape. Is very hard.
At the beginning of this year, people expected S&P 500 to do well, and it's been performing well, especially in the AI sector. From quantitative perspective, how do you think about the current U.S. equity valuations?
So it's extremely, extremely hard to make money on the movements of, let's say, the S&P, right? It's very, very hard. On the other side it's much easier to make money in the spread or the difference between a company and the S&P. So this is one actually of the useful lessons of quantitative investing. Instead of looking just at the value of a company or the price of a company or the returns of a company in the abstract, look at the relative value of a company compared to its peers or compared to a portfolio that's representative of the market and so on. Because what really matters is the relative value and it's not the absolute value. So many people will think that they're doing great, that they're great investors, but in reality, they are just investing in the market in disguise. So, and maybe they are levering up in one way or another. So they are making twice the returns of the market, but their risk profile is not any better than the market. So that's one, if you're asking me, that's one another lesson to learn from systematic investing. So if you want to invest in S&P, by all means do it. It's actually the lesson of diversified investing, right? It's a diversified invest in indices. Just don't invest actively in them. Build a position that's corresponding to your risk tolerance. Again, learn your risk tolerance, build a position, keep the damn position on all the time.
I would like to ask questions about investment companies using AI. So how is the AI reshaping the field of quantitative investing? You're talking about the investment behavior. I would also like to ask how you see AI changing the way people invest, especially when it comes to helping investors manage their emotions and stay disciplined over time.
Okay, so there are several aspects to this. So for professional investors, AI has had an impact. So in high frequency or very fast systematic investing, um, uh, deep learning techniques have been very important. Okay, very important because they have enabled researchers to identify patterns in these large data sets that were not obvious to begin with. High frequency is a great area for application of machine learning and large data sets because it's really it's really hard to tell a story, to have a good model of how things work out. So, okay, that's number one. Number two, for professional investors who are trading at a lower frequency, AI is making them more productive. It's multiplying their productivity because it's a little bit like an artificial dumb team member that can do all the groundwork for you, collect all the data, scrape web data if needed, and so on. So that's great. It's making people more productive, but it's not replacing their investment process. And I would think that for retail investors, it's a little bit of the same, especially for retail investors. It's democratizing a little bit access to data. Companies like Perplexity offer finance plugins or finance search, so that's also very good. I do not think that it's making them more rational, because it's not replacing their investment decisions, not yet. So in the future, we will see, right? The way that there are agents for buying a travel ticket to New York, maybe there will be agents to invest, but right now we are not quite there.
Let's move to the final questions. In the next couple of years, what non-traditional data sources do you think AI will be able to generate investment insights or better understand the markets?
Maybe, but AI does not necessarily help with that, I think. So it's a different problem. We are scouting for new data all the time, scouting new data all the time. But I don't know that AI can, maybe AI can help with that. You can maybe ask AI, what new data did you see, on an AI agent, scout for new data or new vendors. But it's not particularly new. It's again, it's a little bit like an assistant. Instead of asking a human being, you ask AI, and that's great.
I really appreciate your time, Gabby and Alan. This was a great conversation. For those who like to follow your work or your book, Advanced Portfolio Management and the Elements of a Quantitative Investing, or like people who want to get in touch with you, I know you're active on LinkedIn. Like, where's the best place to reach you?
LinkedIn and X are where I am active, but I am much less active, now than I used to be before starting at Balyasny, because I actually have work to do.
Okay.
So but I still maintain a little bit of a presence, mostly humor, questionable humor, I would say.